If you've been in the space for a bit now, you've probably heard of the term smart money, retail traders, institutional traders, and so on and so forth. But what does all of this even mean? And how are we even supposed to take advantage of it and understand it? Picture it almost like a canvas. Originally, you start out with nothing. And even when you do start, you might be a little concerned on what's currently being done. But this is where the picture is being painted. So now you can create a beautiful picture for a beautiful entry. So without further ado, you already know how we do. Let's get into it. Okay, so in any market, you have three primary market participants. The first one is an institutional investor. They're people working with large amounts of capital. And when they enter the market, we typically notice.
There's this big game going on, and they don't know the rules of the game, and most people don't even know that there's a game game being played. People that are trading or investing and not successful, maybe they're losing, maybe they're not losing but not making any money. The reason is because they're thinking and trading like a retail trader. We try to do it when I try to talk about it at the events and Online Trading Academy is you need to stop, get out of that world and start thinking and trading like an institution. And coming from the trading floor, the Chicago Mercantile Exchange, you see that both groups.
Basically, look at it like this. The institutions provide the momentum in order to get the push started. It's the retail traders that fuel that push. So because we typically react off of emotion and we're usually late to the party, we're always trying to catch up. Whereas like the institutions, they're planning themselves strategically in a way where it's like, no, we're getting in where the market's highly liquid. So that way we have an easy execution since we're moving such large positions in this market. And then now, because we're impacting price so much at that area, now we're causing the market to shift. All we have to do is let the retail traders basically flood the market with their money, and we just got to sit back and watch our position grow. So I think the big question that people should be asking is not when are these guys entering the market or how are they entering the market? It's where are they entering in the market? The thing with these institutions, these banks, these people moving large amounts of capital, they can't enter in where everybody else is entering in. They have to enter in areas that are highly liquid. It's important to understand too that when it comes to trading and investing, you don't see patterns and trends form just from a bunch of noise in an area. You see these trends and these patterns form after the storm's already subsided. It was the storm that basically set up the opportunity. When you really understand what the markets are telling you, you gain a massive edge, because that push that we've seen recently, what that was it was a lot of hope and it was a lot of greed. And typically when those two emotions rise in the market is when people get fucked out for the money. And we already seen this bit of a move to the upside, that a lot of people right now are likely placing their stop losses at this low here. And this is likely where the market wants to move to first. I'm saying the market like as if it's a person. Okay, now look at that. Since we are now here and we are now sitting in consolidation in this area of support, we haven't broke past this low. All they wanted to do was just trigger the orders here. And by triggering the orders here, now this will cause a bit of a pump back in price. But it's not this move that the institutions are looking for. Now, this is a point that I talk about all the time. You'll hear me talk about in almost every one of my videos. And this is one of the key tools, I guess you could call it, for identifying where institutions and smart money are typically looking to get in the market. So this would be relative equal lows and relative equal highs. So now I understand that this is likely where the institutions are looking to position themselves. Not here, where the retail traders would have been getting in, they're looking for here. And this is where the retail traders would have been placing their stop losses.
Institutional traders are taught from their first day that they buy good levels or they don't buy at all. Unfortunately, most retail traders will wait for some confirmation before they get in. That could be a candle pattern, could be a moving average cross, or whatever. Institutional traders will buy at the level. Now, most traders will put their stop loss a tick under the last low, and they will invariably put their stop loss at exactly where the institutional orders are. I think that institutional traders are just doing what institutional traders do, putting their entry points at very good levels. However, if you are trading at the institutional level, it's not always easy to get filled. At the retail level, if you want to buy 100 shares, you want to buy the pound against the dollar at a 5 or a point, you press the little button and you've got it. At the institutional level, it's not that simple, and you've got, on occasions, to actually generate the liquidity to get aboard. I don't think that anybody looks at where the stops are, but they will say to themselves, well, we know pretty sure that most of the stops will all be crowded around this obvious level. So they will bid the market at that particular level. All you need is one person to chicken out, and the markets are going to go where the bids are, and all those people will be taken out.
So watch this. Now, I would likely have a limit order placed at the lows here with my stop loss between 1 to 2%. So we got 1.2%. And then now I'm looking for, okay, where would I be able to take profit? I'm seeing some relative equal highs being formed here. So this could be my area of take profit. We also have support here with this fair value gap. So this is almost a guaranteed entry. Look at that. Look at that. There's a prime example of how understanding where the institutions are looking to position themselves, you can now take advantage of that too. So you might be wondering, well, you're in the higher time frame, you're in a daily time frame. What if I wanted to enter that but not hold it as long? Because this is a bit of a, like, if you're as a trader, this is a bit of a hold. You don't have to take that massive ass price movement. You use the higher time frames as your navigation tool, the lower time frames as your execution tool. So by identifying the areas of interest in the higher time frame, you don't even have to be looking for this massive run. You might now come into the chart with your understanding that, okay, below relative equal lows and relative equal highs is an area where institutions are likely to get in at. So now you know that I can start looking into a lower time frame for points of interest. So you could have even taken this trade here. After we see the market drop down here, not break outside of this gap, now you could have had a solid entry right in here. And then you might be wondering, well, how would I have gotten in an entry on that position? I am going to talk about this later in the series. You don't have to know when the market will move or how it will move. You just have to understand where it is likely to move. You don't have to understand all of that short-term price movement in order to take advantage of the longer-term trends. It's really just about understanding where the market is likely to flip the switch, and that will allow you to now make more informed decisions in the market without getting stopped out or losing your profits due to impulsive decisions. Successful trading is largely a process of selective waiting, and markets tend to reward those who wait for price to move into areas where meaningful participation is more likely. Now, this doesn't mean you don't need to or you can't follow a strategy or even memorize a pattern, but by understanding what the markets are actually telling you, you can now tie this into whatever strategy or pattern you're using. This, in fact, could be your primary source of creating an entry, but you should be using these tools together while also keeping it simple. I think we really lost the art of just keeping things simple. We tend to overcomplicate things, and I did that a lot within my own personal life, which caused a lot of tension and a lot of miscommunication with myself and others. Now that we have a solid grasp on what an institutional investor is and where they like to position themselves, now that brings us into what is a market maker and what is a retail trader. Market makers, basically what they are is they're either computers or they're people, and what their general purpose is really just to try to keep the market balanced.
Is the pilot. He's there to create a smooth and active market. He's there to inject liquidity into the market. In the absence of a buyer, he has to buy it. In the absence of a seller, he has to sell it.
So basically, the purpose of a market maker is just to keep the market stabilized. It's really just to make sure that the market isn't going too crazy in one direction and not getting any attention in the other direction. I just wanted to make this one clear distinction as well. So right now I'm in the Forex market, and the example that I showed earlier was in the Forex market. Now, the concepts and ideas that I present in this Patreon around price action in the markets, you can use them like they work. You know what I mean? You just have to go use them for yourself. But when it comes to really seeing where individuals are buying and selling, the best way to do that is with the order book. But it's important to also understand that the order book can be very misleading, especially when it comes to short-term movement. As a trader, or an investor too, I can't see who's placing what where. I just understand market dynamics, which allows me to understand where these orders are likely to be placed. And that's why I can take advantage of these short or long-term movements in price action. So across different markets, you have different types of participants, and the roles of market makers and other players change depending on the market structure. So when you're looking at something like crypto, for instance, or, I'll just use Bitcoin for the prime example, just because it's like the most talked about thing in regards to crypto. But crypto is mostly dominated by speculators. Now, that's not to say that investors aren't a part of crypto, or institutional investors aren't a part of crypto. They are, and they're heavily into crypto. Crypto is literally reshaping the way we now approach the financial system. But you have to remember that, yeah, it's speculators really that are really driving the prices of crypto and everything. Now, the institutions, they're putting a lot of money into it as well, but it's our beliefs and our emotions that are really causing all of these movements in price to happen. I'm sure the institutions are kind of just sitting back right now watching it all happen as all of these retail traders are in the market. And that's not to say that's exactly how it is, but it's typically when the markets are quiet, the primary markets are quiet, you see these small markets pumping. And that's where there are really no market makers. The institutions don't really have to do much in order to gain much. They just have to wait, be patient, and then push all of these narratives and stories, which will now alter the psychology of people, which now alters the decisions they make in the market, which now allows for better opportunities. So when we're looking at crypto and stocks and futures, it's really the stocks, the futures, and the Forex markets is where you see the impact of these market makers. The stock market is largely dominated by institutions, so like mutual funds, pension funds, investment banks, and this is due to the size of maturity of the market, as well as strict regulatory requirements. But Then you have the futures market, and the futures market is primarily dominated by professional participants such as hedge fund traders, proprietary trading firms, and then also as well as institutional speculators. And speculators is basically another way of saying individual investors, so a retail trader. So you do have the institutional traders that now might be retail traders, but still trading large sums of capital, so they're still considered smart money. But then you have the Forex market. I don't really plan to talk about the Forex, like all the markets. I just wanted to talk about the market participants and kind of the roles in these markets. So then you have the Forex market, which is dominated largely by commercial and central banks, which provide the majority of liquidity. And that's why you see within the price movement of Bitcoin compared to the Euro USD, Bitcoin movements are typically a lot more aggressive than the Forex markets because there's market makers in these markets. So they're now kind of helping to rebalance that price out. Now, like I said earlier, everything that I talk about is still applicable across all charts. So when we talk about speculators or retail traders, we are the retail traders. It is the beliefs and emotions of traders in the market that cause the market to move. So when we see all of these short-term movements in price, usually or typically that's a cause of people feeling greed, fear, and hope. And it's at these times is when you, if you're positioning yourself properly and understand where these zones are forming, you can now take advantage of it. Because if you remember what I said earlier, it is the calm before the storm. And I will be creating a video on the market and identifying what zones we're in, but that's for a later video. The primary areas of interest that you want to look for within a market is the accumulation phase, the distribution phase, the consolidation phase, and then as well as the expansion phase. When you understand what emotions are rising at each phase, you now know what's likely to come after, so you can prepare yourself wisely for it. So if I was to look at this right here, okay, and I was looking at this massive drop in price, what this is a result of is fear, okay? Now, where that fear was, we'll see in a moment. It was here. And the reason why it was here, there was also relative equal highs placed here, so we know that this is a point of interest for the market. But aside from the relative equal highs, the reason why there was fear in such a massive sell-off after is because people seen that the market didn't have enough momentum to reach up here. So as they seen these candles starting to get smaller, especially once they seen this one here, they understood that likely that the market's going to start pulling back. So it's likely the institutions initiated this trade, or the market makers, and then it's the retail traders that start FOMOing in, and they provide the volume to kind of keep that push moving. And that's why the push was so aggressive. And this is where a lot of people would have got stopped out right there. But a lot of individuals don't understand what the market's really telling you. So we don't see this. We don't see that there was a lot of greed here in this movement. There was a lot of greed, and there was a lot of hope. And when there's greed and hope, that's usually when everybody gets fucked, right? So that's why we seen the little rebound. That's that hope. And then we see the distribution phase. So we see in the expansion phase, we see in the consolidation phase, and then we see in the distribution phase. And then that's when we started to see the market pullback. But it's just by understanding that this distribution phase was really just a phase to take out the orders here, not necessarily just to take them out, but to grab that liquidity. And then Now, this allows for a much smoother entry for institutions and an even bigger opportunity for them to take profit. So now what you would likely see is, since we broke below this line, now we're going to see a pump up to the highs. And there it is. And this is why it's important to understand, one, what the market's telling you in regards to what retail traders are doing and how they're feeling, and two, what institutions are looking for. Because when you understand what the retail traders are thinking and doing, this completely throws out all that short-term noise. So you stay away from making these impulsive decisions just because you're looking at the market. Right? And when you look at the market, this often causes your nervous system to start going off, which is what now leads to our impulsive decisions that we make in the market. But because we don't understand what it's telling us based off of what the retail traders are doing, we don't have a clear mind at all of this. And by tying what the retail traders are thinking and doing, and then as well as where the institutions are looking to get in, now you have a beautiful canvas that's painted that allows you to create that beautiful entry. So I hope you guys enjoyed this video. That's all I got for you guys today. We will be live on Monday for the Monday Market Mashup. So anyways, stay blessed from the bird.